Hello my dear students, today I have come up with a new chapter called depreciation. Depreciation, as we know, is a wear and tear of any kind of asset. Any asset has certain value, or when we buy, the cost price is there, but it has some estimated life, and during that life every year it goes through wear and tear or depreciation. So depreciation can happen due to many reasons, like when we buy a asset, due to passing of certain time, gradually it becomes like second hand. So the depreciation starts. Now sometime maybe some accident may happen, then also depreciation may happen. So depreciation means wear and tear of an asset due to afflux of time, or maybe due to some kind of incident like accident, etc. Now depreciation has to be shown in the books of account, and before we start with depreciation, let us discuss that for practical purpose we need to show depreciation in two methods. First is straight line method, that is fixed installment method, and second is diminishing value method, that is written down method. So both the methods have certain difference in the workings. Straight line method means the value of depreciation is same every year, and diminishing value means it reduces every year. So when we prepare depreciation account, we have to know the journal entries. First, the working we need to know. In both the circumstances, both the methods, how to do the working. Second, the journal entries we should know. And third, we should know the necessary ledgers to be prepared. The first ledger to be prepared is the asset account. Second is the depreciation account. So now let's start with the working part, which is very fundamental and very important for this chapter. Now when the machine is purchased, let us assume the machine is of 1 lakh and depreciation is 10% per annum. We will show the working in both the method here. Let's have a look. The value of machine is suppose 1 lakh, and depreciation is at the rate of 10% per annum. Now method number 1 is straight line method, and method number 2 is diminishing value method. So in both the methods, let us try and do in both the methods the working how we can do. In straight line method, suppose the value of machinery is suppose 1 lakh and depreciation is 10%, means first year how much it will be? 10 by 100 into 1 lakh, that is 10,000. So this is the book value present. Second year it is 10 by 100 into 1 lakh, because it's a straight line method. The depreciation value will be calculated on the original cost. So it will be again 10,000, 80,000. And third year it will be again 10 by 100 into 1 lakh, that is 10,000. So book value comes to 70,000 in the third year. If we sell it in 60,000, suppose we sell it in 60,000, that is less than the book value. This is our loss of 10,000. Okay, and if we sell it on, suppose sale value is suppose 75,000, because it is more than the book value, then there will be profit of rupees 5,000. Fine. So this is one method. Now let us come to another method, that is written down method. Let's know the working. Value of machinery is 1 lakh in both the cases. First year depreciation will be 10 by 100 into 1 lakh. So remember one thing, first year depreciation in both the methods it will be same, because we are directly showing. Now comes the difference, that is the second year depreciation. Second year depreciation will be 10 by 100 into 90,000. Diminishing value method or written down method means the value is diminishing, the value is reducing. So 10,000 is reduced, now up in 90,000 you will show. So amount will be 9,000. Fine. Now 81,000 is the balance. Now in the third year, depreciation will be on 10% of 81,000. That is 8,100. So this is the book value. Now this is the book value of the asset. If we sell more than this value, it will be our profit, and if we sell lesser than this value, it will be our loss. So basically, most important thing we have understood here, the working part. In case of straight line, the value of depreciation will be same throughout. In case of diminishing value method, the value of depreciation will decrease because the book value keeps on decreasing. So depreciation is calculated first in this value, then second in this value, third in this value. Okay. So this is the basic things. Now we will do our journal. We should know what are the journals needed here. So basically I just discuss here the journal. First, when we buy any kind of asset, the entry will be asset account debited to bank account. See, when we buy any kind of asset account debited to bank account, and in that bank account you have to include all the charges like installation charge, carriage charge, everything should be shown, and the value of asset together will come inclusive of everything. Then this happens whenever any asset is purchased. Now at the end of every year you have to pass two journal entry. First journal is depreciation account. First journal is depreciation account debited to asset account. This is at the end of the year, okay? This is on the date of purchase. And this is end of every year. Okay? Depreciation to asset account first, then the same value of depreciation will be closed by transferring to profit and loss account. Entry will be PL account debited to depreciation account. So these two entries have to be passed together at the end of every year, or if any asset is sold, that is on the date of sale. Whenever we sell the asset, we must always calculate the value of depreciation before we sell, because we all know that asset goes through the wear and tear process till it is in your hand. So the date of sale you have to show the depreciation value, then you can sell. Now when we sell the asset, what is the entry? When we sell any kind of asset, sale of asset, we get the money. So entry will be bank account debited to asset account. Fine. Bank account debited to asset account when we sell the asset. Now we all know that when we sell the asset, we may either get profit or loss. It is very rare case that the book value is suppose 70,000, we may get directly 70,000. Then there is no profit, no loss. Then no need to pass the profit or loss entry. You just need to pass bank to asset 70,000. Finished. No asset, no profit, no loss. So, but if there is profit, then the entry will be, if it's profit, entry will be asset account debited to gain on sale of asset. Fine. If there is profit. But if there is loss, then loss on sale of asset debited to asset account. So loss will be debited and gain will be credited. So at the end, today we got to know that first the workings, then the journals, because the journal, through journal you get to know what is the transaction. Now basically for exam purpose you need to see the journal as well as a ledger. Now through these journal only you make the ledger account. Ledger account of asset and ledger account of depreciation. So first, now we show how the ledger is done. Now as I have said that the last point required is making the ledger account. We have seen how to do the workings. We know what are the journal needed. Now how we'll make both the ledgers which are mandatory in our depreciation account. See here, first this is asset account, then the depreciation account. Asset account means whatever asset you buy. Suppose if it's machinery, then you write machinery account. If it's plant and machinery, write plant and machinery. Now when we buy the asset, first of all you have to write the date when you buy the asset. Whenever you buy the asset to bank, because you are purchasing the asset. Then at the end of that year, suppose if it's a financial year, then 31st March of that particular year ending, end of the year, the date you have to write, then you have to show the depreciation of that do in ledger, the debit side will be higher than credit. The balancing figure will come by balance CD, and this will again come to the next year, the opening balance of next year, to balance BD. Now this year, what is the entry? Bank account, asset account debited to bank. Then the entry was depreciation account debited to asset account. So depreciation account debited to asset account, and then it is closed by transferring to PL account. The entry will be PL account debited to depreciation account. So in depreciation account will be by PL account. There's the same amount and it will be closed. Every year it will be closed. Year ending and every year it will be closed. For example, in the second year we purchase one more asset. Then we have to write here to bank account, because when we purchase asset, we have to write on the debit side to bank account, right? Then suppose on the second year, what we do, we have to show the depreciation of both the asset. By depreciation, asset number 1 is how much, asset number 2 is how much, the total you will write here. Then you have to show the balancing figure by balance CD. Asset number 1, what is the balancing figure? Asset number 2, what is the balancing figure? The total you have to show. This total, and after that you have to close it. You have to do the total of debit side. You have to write on the both side, it will be same. Now this closing balance will come in the next year as opening balance. So whenever any asset is purchased, remember that it will come here, and if any asset is sold, it will come here. So this balance will come here to balance brought down asset number 1, asset number 2. Fine, this is the balance which comes here directly. Now for example, asset this second year is closed here. The same process we'll do in the depreciation account in the second year, to asset with the value of depreciation, and then by PL account, closing of the depreciation account. So this is done. Third year, for example, this asset 1 is sold. So what will you do if the asset is sold? First you have to write by depreciation with the value of the depreciation of the asset that we are selling. Suppose if we sell in the middle of the year, then we have to show 6 by 12, that is 6 months. So if we sell after 3 months, suppose April, May, June. If we sell on 30th of June, then we have to write 3 by 12. That means the time factor is very important when we do the depreciation. So now by depreciation of asset number 1, whichever we are selling. Now by bank, the amount which we get on the sale of the asset. Fine. Now if there is loss, then we have to write by loss on sale of asset. And if there is profit, we'll write here to gain on sale of asset. For example, if there is loss, then we'll write by loss on sale of asset. Fine. So this is done. Now we will depreciate asset number 2, because 2 is still there. Then we have to write the balancing figure of asset number 2. Fine. Then again we have to close. Now after closing, this will come as the opening balance of next year. Now suppose for 3 years we have to do, this is first year, this is second year, and this is the third year. Fine. Now the same way, third year, after doing this, we have to close the depreciation account. So depreciation account debited to asset on the third year, okay. Then by PL account. That means whenever you write depreciation account, in this case, you have to write this depreciation also, which we have calculated in the middle of the year, because you have sold in the middle of year, and you have to write this depreciation also. Both the depreciation you have make it a total, then you have to write here. It doesn't mean that you will show only one depreciation account. The depreciation overall, that is the total depreciation you have to show. The total depreciation you have to show it as depreciation to asset. Then again we will be closing as PL account or depreciation. So ultimately these are the necessary ledger account. Most important thing which you have to see is, first, depreciation of asset. You have to see number of asset, 1, 2, 3, you have to number them. Second, the rate of depreciation, whether 10%, 15%, 20%, rate you have to remember. Third, which method they are applying. That is very important. Either straight line or diminishing, that we only have to calculate. Fourth, most important, how many years of depreciation account you have to show. Suppose you have started buying the asset on 1st of April 2020, and if they say you have to show till 3 years, 1st April 2020 to 31st March 21, 31st March 22, 31st March 23, till that you have to close all the account. Doesn't mean that 22 if you buy asset you will again show 3 years. That is not needed. Okay, in the question if they say 3 years means 3 year overall, all the asset. And most important, please remember this, students, that whenever you make this depreciation account, we should always remember very clearly the date of purchase of asset, and if we are selling any asset, the date of sale, because depreciation is to be calculated from the date of purchase till the end of the year, and from the beginning of year to the date of sell. Whenever we sell the asset, we have to calculate depreciation from the beginning of the year till the date in which we held it in our hands. So that means depreciation is happening on the wear and tear of an asset. So time factor is very important, in which many students make error. So I hope you have understood it. But still, if you need any detailed video on this topic with particular example, you can just comment me. I am ready for the video. Hope you have understood. For doubt, you can comment me. Like, share and subscribe. Bye bye for now.